Today is the 17th of January 2020. This is our first market update for the new year, so a happy new year to all of you. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500 and discussing the 20-week cycle trough that lies ahead. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. In my previous market update on the 20th of December, around about here on the chart, I discussed the formation of the 80-day cycle trough at the beginning of December and provided my reasons for why I believed that was the 80-day cycle trough. And nothing has changed in terms of the analysis, so let's zoom in and take a closer look and consider, of course, what we are expecting to happen next. At this zoom scale, let's take a look at the 20-day FLD, which is a very useful FLD. And here you can see the 80-day cycle trough that formed on the 3rd of December. You can see there have been 45 days since that cycle trough formed. And since then, we have seen price bounce out of the 80-day cycle trough. And we have seen it drop down below the 20-day FLD as it came down to form the 40-day cycle trough, which in my opinion formed on the 8th of January. So let's discuss this price action in a little more detail. The first thing, of course, is that we track the interactions between price and the FLD, as you know, and I label those interactions. So here is the A category interaction. The next interaction is as price comes down towards the 20-day cycle trough. So now that we can look back and identify where that 20-day cycle trough formed, identifying the B category interaction is simply a matter of identifying the time at which price came down towards that 20-day cycle trough, which was this one single little lonely bar over here where price actually moved down into that 20-day cycle trough. We could debate whether the move down actually happened on the weekend prior to that, but at this time the exact positioning of that 20-day cycle trough is not absolutely critical. Nevertheless, this is our B category interaction. And if you don't understand why there is no interaction between price and the FLD at that point, I must remind you that an interaction is usually or often a matter of price crossing over the FLD, or perhaps sometimes coming to the FLD and finding support or resistance. But sometimes it could be a matter of price simply moving towards the FLD. Okay, so that would be defined as the B category interaction. And I've discussed all of this in previous market update videos, so if any of this confuses you, please make sure that you take a look at those videos. Then the C category interaction is where price moves away from the FLD following the 20-day cycle trough. Now, at the time, how would we have known that the 20-day cycle trough was forming? Well, the average length of a 20-day cycle is 17 days, and you can see that 17 days was on this day over here. I think that was, in fact, the 20th of December. And so we were expecting a 20-day cycle trough to form around about this time. So what does it mean that price didn't come down and find support at the level of the 20-day FLD, which is what it is expected to do at the B category interaction? A usual or a normal B category interaction is where price finds support at the level of the 20-day FLD. So how do we understand or how do we interpret the fact that it didn't even get anywhere near the FLD? That, as I have explained in previous market update videos, gives us an indication of the bullishness or bearishness that is present in the market. And the fact that the price didn't manage to reach the FLD was a clear indication that this market is very bullish. And we've had many indications over the past several months that there's a great deal of bullishness in this market, which, as I've discussed in previous market update videos, is because of the longer cycles which are pushing upwards and providing us with a great deal of bullishness. So we have a bullish market. There's no great surprise there. And as price then approached the time at which was expected to form the 40-day cycle trough, and let's just identify when that was. The average length of a 40-day cycle, you should know, is 36 days. And with the fact that the average length is 36 days, and yet we call the cycle a 40-day cycle, confuses you, then please make sure that you download the free 10 Core Concepts of Hurst Cycles PDF. I will put a link to that in the description below this video. The fact is we call the cycle a 40-day cycle, but the average length of the cycle over a very long period of time has been found to be 36 days. And so at 36 days, we expected the 40-day cycle trough to form. There was, in fact, a trough on that day, on the 8th of January. As you can see, that was exactly 36 days. And so when price came down to form that 40-day cycle trough, that interaction with the FLD was the D category interaction. And we expect price to cross down below the FLD, fairly accurately achieve its target as it forms the 40-day cycle trough, and then to bounce back out of the 40-day cycle trough in an E category interaction. So price came down and sort of touched the FLD, and I had some questions about how you actually calculate the point at which price crosses the FLD. So let me answer that question quickly. Let me just erase all of that. Okay, so the correct answer really to where price crosses the FLD is that price is considered to have crossed the FLD when the median price crosses below the FLD. The FLD itself is based upon the median price, and so when those two lines that you can see are exact replicas of each other, when they cross, that is the official crossing point. And so here you can see the median line is showing us that although the median price touched the FLD at this point over here between Christmas and New Year, the actual point at which the median price crossed the FLD was over here. So officially that is the price cross, and when price crossed at that point, we were able to calculate a target, and the target is very simply calculated. You take the previous high, which I think was 32.63, you take the level of the cross, which was 32.33, and you generate a target which was at a level of 32.03. A D category interaction usually achieves its target fairly accurately and then bounces back up out again from the 40-day cycle trough, and that's exactly what we saw happen over here. So there were no big surprises. Everything was working as clockwork, the way that the Hurst cycles indicate that it should work. So that was almost certainly our 40-day cycle trough, and as it happened, I hope that many of you were able to observe that and say, okay, there's our 40-day cycle trough. Price was then bouncing out of the 40-day cycle trough. As I've mentioned, we have a sequence from A, B, C, D, E, and our next interaction is the F category interaction, where price is expected to cross down below the 20-day FLD on the way down to the 20-week cycle trough, which, as you can see from this neat stack of circle and whiskers, what is called a nest of lows, is expected in about the second week of February, or towards the end of the first week of February, about the 9th or 10th of February is when that 20-week cycle trough is expected. So let's consider this F category interactions, because these interactions not only provide us with information about the analysis and help us to refine our analysis, they also provide us with trading opportunities. Usually, an F category interaction provides us with a good, profitable short trading opportunity. Is that going to be the case? No, in my opinion, it isn't. As I have mentioned, we have a tremendous amount of bullishness in this market. We had the fact that the price was unable to reach the 20-day FLD at around about the time of the 20-day cycle trough. We had a very accurately achieved target for the D category interaction. There is clearly a lot of bullishness. The target generated from the E category interaction, which you can probably calculate really easily for yourself, calculated from this low up to the point at which it crossed the FLD, generated a target over here, and the fact that price has exceeded that target, as it has, indicates that there is still a great deal of bullishness in this market. And so I do not believe that the F category interaction, which will or should occur as price moves down towards the 20-week cycle trough, I do not believe that it is going to give us a good short trading opportunity. What is going to give us a better trading opportunity, in my opinion, will be the bounce out of this 20-week cycle trough because of the recent bullishness in the market. Now, of course, bullishness in the market is not going to continue forever. Where is the bullishness coming from? It's coming from the longer cycles. So we will zoom out in a moment and take a look at how long that bullishness is expected to last. But if all of this rather abstract discussion of interactions between price and the FLD makes it a little hard for you to visualize what is happening, a very useful tool to consider is the Composite model line, which takes the results of the cycle analysis and plots the analysis information in terms of the cycle wavelength and the amplitude on the chart and projects that into the future, and it shows us what we should expect on the basis of the analysis that we see on the chart. It's not so much a forecast line as an indication of what would happen if these cycles continue beating as they have been recently. It's quite an important distinction, but I won't dwell on it here. The important thing is that the composite model line gives us a very quick visual indication of what to expect on the basis of the analysis. And that is that price is going to come down and probably cross below the 20-day FLD, which will be the F category interaction. It'll then give us a little bit of a bounce back up again. That would be our G category interaction. Then we will have a drop down, an H category interaction, and here is where that 20-week cycle trough is going to form. But as I think you can see from the composite model line, the most interesting thing that's going to happen over the next few weeks is going to be the bounce out of the 20-week cycle trough, which should give us a profitable long trading opportunity. Of course, if price drops down really strongly into the 20-week cycle trough, that would be an indication that some bearishness has entered into the market, and we would need to consider things fairly carefully. So let's take a look at that bullishness that has been operating in the market recently, and in order to do that we will zoom out, and let me just adjust this. And so here is the slightly longer term perspective. Here is the 20-week cycle trough that we are expecting here in February. If we look at the composite model line, you can see the next sort of big event in terms of us being able to trade this market, depending of course on your time frame. It's very important to bear in mind your time frame. Some people say to me, what's your next considered trade? And they're looking at hours ahead rather than days or weeks or months or years. So you need to, of course, bear in mind the time frame that we're discussing here. So the next interesting trade, in my opinion, is going to be that long trade bouncing out of the 20-week cycle trough. Then we do expect to see some bearishness coming into this market, although the composite model line is not showing very much bearishness. But we do expect to see some bearishness over a period of several months because price is expected to come down and form this 18-month cycle trough towards about the middle of this year, a little after the middle of this year. And so that is really the bigger picture. Over the near term, we're expecting the 20-week cycle trough to form. When that cycle trough forms, we will, of course, reassess that situation and ask ourselves, is this going to be a good, profitable, long trading opportunity? Unless there have been signs of bearishness already developing in the market, that should give us a long trading opportunity. But the bearishness must inevitably start creeping in because of this 18-month cycle, which should be in the process of turning down. And because that 18-month cycle is going to start pressing down, we are going to start seeing some bearishness coming in. But bear in mind the comments that I made in a video that I recorded. I think it was the November video where I discussed the much bigger picture and the fact that this trough in 2018 was probably a trough of maybe a 6-year cycle or maybe a 54-month cycle. So those cycles are probably still pushing up. So we are going to have a constant battle between the cycles. With those longer cycles pushing up, there is still going to be some bullishness in the market. And so the fact that one cycle has turned down does not necessarily mean that it's time for us to start being bearish. We need to observe what is happening in terms of how price is reacting to the pressure from the cycles and react accordingly. I do hope you found this market update useful and interesting. Thank you as always for your interest in Hurst Cycles. Please let me know if you have any questions. Put them into the comments below this video or send us an email. I always look forward to hearing from you.